Today is the day the world of finance feared would never come. It's December 31st, 2025, and as the clock strikes midnight, an era that defined modern capitalism is officially coming to a close. Warren Buffett, the Oracle of Omaha, the man who turned a failing textile mill into a trillion-dollar empire, is officially stepping down. But while the world is busy celebrating his legendary career, a massive $300 billion crisis is brewing behind the scenes at Berkshire Hathaway, one that could change the fate of your portfolio forever. There is a shocking truth about who is actually going to be pulling the strings of the world EOS most famous stock portfolio starting tomorrow, and it's not who you think. Before we pull back the curtain on the secret power struggle happening inside Kiewit Plaza and reveal why the departure of one key executive has sent shockwaves through Wall Street, you need to understand exactly what's at stake for your money. If you want to stay ahead of the markets in this new post-Buffett era, make sure you hit that subscribe button and ring the notification bell. Because the next 10 minutes could be the difference between riding the next wave of Berkshire growth or being left behind in the wreckage of a 60-year legacy. The headlines today are focused on Greg Abel, the hand-picked successor, who officially becomes CEO on January 1st, 2026. For years, we've been told the transition would be seamless. We've been told that the culture of Berkshire is the real CEO. But today's bombshell report from CNBC has revealed a massive crack in that foundation. While Greg Abel is an operational genius who knows how to run energy plants and railroads better than anyone on earth, he is not a stock picker. And that's where the $300 billion problem begins. For decades, the three-headed monster of Berkshire's investment strategy consisted of Warren Buffett, Todd Combs, and Ted Weschler. They were the holy trinity of value investing. But as of this morning, that trinity has been shattered. Todd Combs, the man many believed was the heir apparent to the entire equity portfolio, is officially walking away. He's heading to JP Chase, leaving a massive vacuum at the top of the world's most watched portfolio. Imagine for a second that you are Greg Abel. You're taking over a company that is more of a sovereign nation than a corporation. You have $380 billion in cold, hard cash sitting on the sidelines, a record-breaking mountain of dry powder. You have a $300 billion equity portfolio filled with massive stakes in Apple, American Express, and Coca-Cola. And suddenly, the guy who was supposed to help you manage all of that just walked out the door. This isn't just a personnel change, it's a fundamental shift in the DNA of Berkshire Hathaway. For 60 years, the Omaha way was defined by decentralization and the singular genius of Warren Buffett. Buffett didn't need a massive team of analysts. He didn't need a general counsel or layers of corporate bureaucracy. He had his brain, a stack of annual reports, and a landline telephone. But the article we're re-looking at today makes one thing very clear. That version of Berkshire Hathaway died this morning. The transition we are witnessing is the corporatization of the Oracle's legacy. We are moving from a philosopher king model of leadership to a standard corporate structure. Berkshire is now hiring a general counsel. They are adding management layers. They are becoming normal. And in the world of investing, normal usually doesn't deliver the market-beating returns that made Buffett a household name. The shocking truth is that the $300 billion equity portfolio is now an open question. With Todd Combs gone, Ted Weschler is the last man standing. Can one man manage $300 billion in equities while Greg Abel focuses on the sprawling web of 60-plus subsidiary companies? Or will Berkshire be forced to do the unthinkable, hire outside help? Let's talk about that $380 billion cash pile for a moment, because this is where the story gets even more intense. We are entering 2026 in a world where interest rates are beginning to fall. For the last 2 years, Buffett was happy to let that cash sit in T-bills, printing billions in easy interest. It was the ultimate wait-and-see move. But now that wait is over and the C is looking very complicated, Greg Abel is an operator. He's the guy you call when a power grid goes down or a railroad needs optimizing. He is not the guy who has spent his life studying the intrinsic value of tech startups or consumer staples. The market is already starting to ask, will Abel have the discipline to sit on that cash until the fat pitch arrives? Or will the pressure of being a normal CEO lead him to make a massive overpriced acquisition just to prove he can do the job? The departure of Todd Combs to JP Morgan is the smoking gun here. Combs wasn't just an employee, he was a protege. He was the one who pushed Buffett into the 21st century, famously being credited with the initial move into Apple, a move that arguably saved Berkshire's performance over the last decade. Without Combs, is there anyone left in the room to tell Greg Abel no? Is there anyone left with the investment DNA to spot the next Apple? Ted Weschler is brilliant, don't get me wrong, but the article highlights a growing concern among institutional investors. The Omaha way was built on the synergy between Buffett's capital allocation and his lieutenant's modern insights. With the Oracle retiring and the protege leaving, the synergy is gone. We are looking at a $1 trillion company that is effectively becoming a massive private equity fund managed by an operations guy. This is the pivot point. If you look at the stock price of Berkshire today, the market is holding its breath. There is a Buffett premium that has been baked into this stock for half a century. People didn't just buy Berkshire because it owned Geico and See's Candies. They bought it because they trusted Warren Buffett to know what to do with the profit those companies generated. Now, that trust has to be transferred to Greg Abel. But Abel is inheriting a very different world than the one Buffett started in. He's inheriting a world of high-frequency trading, AI-driven markets, and a Berkshire that is so large, it can basically only move the needle by buying entire companies. This is the end of the philosopher era. Buffett's annual letters were like scripture for investors. He taught us about moats, about margin of safety, and about being greedy when others are fearful. Greg Abel's letters will likely be different. They will be about operational efficiency, regulatory compliance, and infrastructure synergy. It's a shift from the why of investing to the how of running a conglomerate. And for the $300 billion equity portfolio, that shift is terrifying. Does an operator CEO even want a $300 billion stock portfolio? Or will we see Berkshire slowly liquidate its holdings to fund more operating acquisitions? Will the Apple stake, the crown jewel of the portfolio, be trimmed even further to pay for a massive utility buyout? These are the questions that are currently keeping the biggest whales on Wall Street awake at night. Let's look at the numbers, because they tell a story that the mainstream media is largely ignoring. Berkshire is currently trading at around 1.6 times book value. In a market that is increasingly looking like a bubble, specifically in the AI sector, that is a remarkably conservative valuation. But here is the catch. About 35% of Berkshire's entire market value is now just cash. That is unprecedented. Imagine buying a house and finding out that $350,000 of your $1 million purchase price is just a suitcase of cash sitting in the hallway. That's Berkshire today. But that cash isn't just sitting there, it's a weapon. And Greg Abel is the man who now has his finger on the trigger. The real mystery is why Buffett has been selling so aggressively leading up to this retirement date. He didn't just trim Apple, he essentially dismantled the position, taking it from over 50% of the portfolio down to roughly 20%. He did the same with Bank of America. It's as if Buffett spent his final 18 months in power clearing the decks. Some analysts call this a blank canvas for Greg Abel, but I see it differently. I see it as a final warning from the greatest investor of all time. Buffett is handing over the keys, not with a full tank of gas and a map to the next big stock, but with a vault full of cash and a clear signal that the current market is too expensive to touch. But here's where things get complicated for the operator CEO. Greg Abel is an accountant by training. He thinks in terms of balance sheets, depreciation, and cash flow yields. This is a man who built Berkshire Hathaway Energy into a global powerhouse by managing complex regulations and multi-billion-dollar infrastructure projects. He is a master of the long game in physical assets. But the public stock market is a different beast entirely. It's driven by sentiment, narrative, and often pure irrationality. Buffett understood the psychology of the market, the Mr. Market analogy he borrowed from Ben Graham. The question is, does Greg Abel have that same temperament? Or will he try to run the $300 billion equity portfolio like a utility company? And then there's Ted Weschler. With Todd Combs heading to JP Morgan to lead their new $10 billion strategic investment group, Weschler is effectively the last pure investor left in the inner circle. For years, Ted and Todd were given $10 billion to $15 billion each to play with as a sort of audition for the top spot. Now, that audition is over, and one of the contestants has left the building. This creates a massive structural problem. If Ted Weschler is managing the equities, but Greg Abel has the final word on all capital allocation, as Buffett explicitly stated at the 2025 annual meeting, what happens when they disagree? In the old days, if Charlie Munger and Warren Buffett disagreed, they'd talk it out over a cherry Coke and a box of CS peanut brittle. It was a partnership of equals. Greg Abel and Ted Weschler have a different dynamic. One is the boss, the other is the specialist. If Abel, the operator, decides that the $380 billion cash pile would be better spent buying FedEx or Boeing, two companies frequently whispered about as 2026 targets, he might start liquidating the stock portfolio to fund those deals. We could be witnessing the slow-motion liquidation of the most successful stock portfolio in history to build the world's largest infrastructure company. This brings us to the succession discount. Wall Street is already pricing in the uncertainty. There was a fear that without Buffett, Rolodex, and his ability to get a call back from any CEO on the planet in 5 minutes, Berkshire loses its greatest competitive advantage. When the 2008 financial crisis hit, companies didn't call the Fed first. They called Warren. He was the lender of last resort. He got the sweetheart deals with Goldman Sachs and General Electric because of who he was. Does Greg Abel get those deals? Does the CEO of a struggling tech giant in 2026 call an accountant in Omaha for a bailout? Probably not. So if you're holding Berkshire stock today, you have to ask yourself, am I buying the oracle or the machine? If you're buying the oracle, you're too late. He's gone. But if you're buying the machine, the insurance float from Geico, the massive cash flows from the railroads, and the fortress-like balance sheet, then you're buying into the Greg Abel era. But even the machine needs a driver who knows when to accelerate and when to brake. The article mentions that Berkshire is moving toward a more typical governance structure. This is code for more lawyers, more committees, and more bureaucracy. In the past, Buffett's hands-off approach was the secret sauce. He let his managers run their businesses without interference. But Abel has already signaled a move toward more active management and operational rigor. He wants to tighten the screws. This tightening could be good for the bottom line in the short term, but it risks destroying the very thing that made Berkshire special: the trust. Managers stayed at Berkshire for their entire careers because they were treated like owners. If they start feeling like middle managers reporting to an auditor, that culture could evaporate overnight. And if the culture goes, the moat goes with it. We're seeing a shift from precision over poetry, as one analyst put it. Buffett was the poet of capitalism. Abel is the accountant. The $300 billion portfolio is now caught in the middle of this cultural tug-of-war. For years, the equity holdings were the high-octane fuel that allowed Berkshire to outperform the S&P 500. But if Abel shifts the focus to safe, utility-like returns, the days of 20% annual gains are officially dead. We're looking at a future where Berkshire is a steady 8% to 10% compounder, a massive diversified mutual fund with a railroad attached. For many investors, that's enough. But for those who grew up on the legend of the oracle, it feels like a betrayal of the original vision. Now, let us look at the smoking gun that most retail investors completely missed in the flurry of today CS retirement news. It's not just that Todd Combs is leaving, it's where he is going and what he is going to be doing. JP Morgan Chase didn't just hire a stock picker, they hired the man who was essentially the acting CEO of GEICO. Jamie Dimon, the CEO of JP Morgan, announced that Combs will head a massive new unit called the Security and Resiliency Initiative, SRI. This isn't a small desk at a bank. This is a $1.5 trillion, 10-year initiative aimed at modernizing American infrastructure, fortifying supply chains, and investing in frontier technologies. Do you see the irony? Todd Combs is leaving Berkshire Hathaway, a company built on infrastructure and insurance, to go build a massive new investment vehicle for the world's largest bank that does exactly what Berkshire used to be the only one doing. For decades, if the U.S. government or a major industrial company needed a massive capital injection, they went to Omaha. Now, Jamie Dimon has essentially built a new Berkshire inside JP Morgan and poached the one guy who knows all of Buffett's secrets to run it. This is a massive vote of no confidence in the new Berkshire. Why would Combs leave the most prestigious investment job in the world? Maybe because at Berkshire, under Greg Abel, the operator era means there is no room for the kind of visionary, flexible capital allocation that Combs thrived on. In his new role, Combs will manage a $10 billion strategic investment group focused on defense, aerospace, healthcare, and energy. These are the exact sectors Berkshire has traditionally dominated. The message is clear. The talent is fleeing the machine for a place where they can still play the Oracle not game. But the departures aren't the only signs of a structural shift. Look at who Berkshire is hiring. For the first time in 60 years, Berkshire Hathaway has appointed a general counsel. Michael O'Sullivan, who spent 8 years at Snap Inc. and decades at the legendary law firm Munger, Tollus, and Olson, is moving to Omaha. Think about that. For 60 years, Buffett famously said he didn't need a general counsel. He didn't even have a PR department. He kept the head office staff to around 25 people. Now, as Abel takes over, the legal department is moving in-house. This is the standardization of Berkshire. When you bring in a general counsel from a tech giant like Snap, you aren't just adding a lawyer, you're adding a layer of compliance, risk management, and corporate friction. Buffett's superpower was speed. He could close a multi-billion-dollar deal on a handshake over a weekend because he didn't have to check with a legal committee. If Greg Abel moves toward a standard corporate structure, that speed, that deal-making alpha, is gone. Berkshire becomes just another slow-moving trillion-dollar tanker in a sea of agile hedge funds. And then there is the elephant in the room, the $382 billion in cash. As of this morning, Berkshire is sitting on the largest cash pile in the history of corporate America. This isn't just dry powder. It's a final warning from Warren Buffett. He's retiring with the markets at all-time highs and the Buffett indicator, the ratio of total market cap to GDP at record-breaking levels. By selling off massive portions of Apple and Bank of America in his final year, Buffett is essentially telling us, I don't see anything worth buying. But Greg Abel doesn't have the luxury of waiting another 10 years for a crash. He is a new CEO. He has a legacy to build. The pressure from Wall Street for him to do something with that $382 billion will be immense. Imagine the 2026 annual meeting, the first one without Buffett as CEO. Shareholders aren't going to want to hear about patience and margin of safety. They are going to want to know why $400 billion is sitting in treasury bills earning 3% when the S&P 500 is ripping. This is the new CEO trap. To prove he's a leader, Abel might be tempted to overpay for a trophy acquisition. He has already expressed interest in renewable energy and infrastructure, sectors that are notoriously expensive right now due to government subsidies and ESG mandates. If Abel pulls the trigger on a $100 billion acquisition at the top of the market, the Buffett premium won't just evaporate. It will turn into a succession discount. The market will realize that the era of disciplined, value-based capital allocation is over, replaced by an era of empire building. We also have to talk about the CFO transition. Mark Hamburg, the longtime CFO who has been Buffett's right-hand man for financials since the 90s, is also preparing to retire, with Charles Chang from Berkshire Hathaway Energy set to take over. This means that by the summer of 2026, the entire old guard will be gone. The CEO, the CFO, and the top investment lieutenant. The machine is being retooled from top to bottom. What does this mean for the $300 billion equity portfolio? Well, look at the recent moves. Berkshire has been quietly moving into safe territory. They've been buying Chubb, an insurance giant. They've been holding on to Coca-Cola and American Express like grim death, but they've been exiting the high-growth, high-multiple names. It looks like the new Berkshire's portfolio is being designed to be a bond proxy. It's designed to be a safe place for pensions and conservative funds to park their money, but it's no longer the place where you go to get rich. If you are a young investor looking for the next Berkshire, you're looking at a ghost. The trillion-dollar company you see today is a monument to what Buffett did, not a roadmap for what Abel will do. The shocking truth is that the most successful investment vehicle in history is essentially turning itself into a giant publicly traded utility company. It will be stable, yes. It will be safe, probably. But the days of outperforming the market by 10% or 20% a year, those retired today, along with Warren. The operator mindset of Greg Abel is also likely to change the way Berkshire interacts with its portfolio companies. Under Buffett, the mandate was simple. Send the cash to Omaha and we'll tell you if we need you to do anything else. It was a relationship built on extreme autonomy. But Abel is a man of systems and processes. The CNBC article mentions that he has spent the last year intensifying his oversight of the non-insurance businesses. For an investor, this is a double-edged sword. On one hand, Abel might find efficiencies that Buffett's hands-off approach missed. On the other hand, he risks alienating the very entrepreneurial talent that makes companies like Precision Cast Parts or Marmon successful. If the Omaha way was about picking the right people and leaving them alone, the Abel way seems to be about picking the right systems and ensuring they are followed. This is a fundamental pivot in the deep psychology of the company. It moves Berkshire away from being a collection of autonomous kingdoms and toward a centralized empire. For the $300 billion equity portfolio, this could mean a move toward more strategic investments. Buying stocks not just because they are cheap, but because they somehow fit into the operational puzzle of Berkshire's existing businesses. This is exactly what normal conglomerates do, and history shows it usually leads to lower returns. And let's talk about the Buffett premium one more time, because this is where the macroeconomic picture gets scary. For 60 years, Berkshire has traded at a premium because investors believed Buffett was a safety net. If the economy crashed, Buffett would find the deals. If a company was in trouble, Buffett would save it. Without that safety net, Berkshire is just another stock. If we see a major market correction in 2026, which many macroeconomic indicators like the inverted yield curve and cooling labor market suggest is overdue, will investors flock to Greg Abel AS Berkshire the same way they did to Warren S&I? The shocking truth might be that Berkshire is no longer a defensive play. If the portfolio is being shifted toward high capex, heavy industry, and utility businesses, it becomes much more sensitive to interest rates and economic cycles. Buffett COMEX portfolio of capital light businesses like Coca-Cola and C.S. Candies was designed to weather any storm. Abel's vision of a Berkshire dominated by energy and infrastructure is a bet on a stable, growing industrial economy. If the macro environment shifts towards stagflation or a deep recession, those heavy industry bets could become massive liabilities. Furthermore, we have to consider the legacy liquidation theory. Some analysts are beginning to whisper that Buffett's massive sales of Apple and Bank of America weren't just about market valuation. They were about right-sizing the company for a leader who isn't an investment genius. By turning those stocks into cash, Buffett has essentially simplified the job for Greg Abel. He's saying, here's a pile of money, go buy some companies you know how to run. But for the shareholders, this is a forced exchange of high-upside tech and banking assets for low-upside, slow-growth industrial assets. The departure of Todd Combs to JP Morgan is the final piece of this puzzle. Combs is a Buffett-style investor. By leaving, he is signaling that the era of Buffett-style investing at Berkshire is over. He is taking his talents to a place that is still willing to make bold, concentrated bets on the future. Meanwhile, Berkshire is settling into its new role as the gold standard of corporate stability. It's the transition from a high-performance sports car to a reliable armored minivan. It will get you where you're going, but the thrill is gone. As we look toward the first quarter of 2026, the $300 billion equity portfolio remains the biggest X factor in finance. Will Ted Weschler be given the freedom to keep hunting for the next big winner? Or will he be relegated to a portfolio manager role, executing trades on behalf of Abel's broader corporate strategy? The article suggests the latter. It mentions that capital allocation decisions will now be more integrated with the overall corporate planning. In plain English, that means the stock pickers now have to ask the accountants for permission. This is why the shocking truth matters to you. If you're holding Berkshire because you want the best investor in the world managing your money, you need to realize that the best investor in the world just walked out the door and his top apprentice just took a job at a bank. You are now invested in a massive $1 trillion infrastructure and insurance conglomerate managed by a very talented operations executive. That is a great business, but it is not the business that made Warren Buffett the richest man in the world. This brings us to the final and perhaps most significant piece of the puzzle. The radical restructuring of Berkshire-S operations that was announced just this morning as the clock ticked down on Buffett's final hours. Greg Abel isn't just taking the wheel, he's rebuilding the entire engine. He has officially announced the creation of a third division within Berkshire Hathaway. Historically, Berkshire was divided into insurance, led by Ajit Jain, and non-insurance, led by Abel. But starting tomorrow, a massive chunk of the non-insurance businesses, everything from NetJets and Dairy Queen to CES Candies and the retail groups, is being carved out and placed under the leadership of Adam Johnson, the current CEO of NetJets. On the surface, this looks like a smart move to lighten Greg Abel's press workload so he can focus on the massive manufacturing and energy sectors. But if you look deeper, this is the ultimate sign of the corporatization of Omaha. By adding this new layer of management, Berkshire is finally becoming the thing Warren Buffett spent 60 years avoiding, a multi-layered bureaucratic conglomerate. This restructuring, combined with the appointment of a general counsel and the departure of the top investment talent, creates a new Berkshire that is structurally designed for capital preservation, not capital growth. The shocking truth is that the $300 billion equity portfolio is no longer the engine of the company. It's becoming the savings account. So, what is the Buffett warning that everyone is missing? Look at the numbers one last time. Buffett has been a net seller of stocks for 12 consecutive quarters. He has sold nearly $200 billion worth of equities in the last 4 years alone. He is leaving his successor with a record $382 billion in cash. If Buffett, the man who famously told us to never bet against America, is sitting on nearly $400 billion in cash and selling his favorite stocks like Apple and Bank of America at the fastest rate in history, what does that tell you about the market in 2026? It tells you that the Oracle isn't just retiring from Berkshire. He's retiring from this market. He is leaving behind a chairman emeritus title, but he is taking his conviction with him. For the first time in 60 years, the smartest man in the room is saying, I'm out. This is the crossroads for every investor watching this video. You have three choices. First, you can follow the operator. If you believe Greg Abel's operational rigor can squeeze more profit out of the railroads and energy plants than Buffett ever could, then you hold your shares. But understand that you are no longer an investor in the Buffett sense. You are a shareholder in a massive, slow-moving industrial utility. Second, you can follow the talent. Todd Combs is heading to JP Morgan to run a $1.5 trillion initiative with a $10 billion blank check for strategic investments. Jamie Dimon is essentially building the 21st century Berkshire inside the world's most powerful bank. If you want the Buffett-style alpha, your eyes should probably be on where the protégés are going, not where they are leaving. Third, you can follow the warning. If you see that $382 billion cash pile as a signal, you might want to start clearing your own decks. Buffett has spent 60 years telling us what to buy. In his final year, he spent his time showing us what to sell. The era of the Oracle is over. Tomorrow morning, Greg Abel wakes up as the CEO of a trillion-dollar machine, and Ted Weschler wakes up as the lone survivor of a broken investment team. I think a shocking truth about the $300 billion portfolio is that its best days are almost certainly behind it. The Buffett premium is gone, and the Abel era begins with more questions than answers. Warren Buffett once said, "It takes 20 years to build a reputation and 5 minutes to ruin it." Greg Abel has 60 years of reputation to protect and $382 billion worth of pressure to perform. The world is watching to see if the machine can survive without the man. But what about you? Are you staying on the Berkshire train, or are you getting off at the Omaha station? Let me know in the comments below. Do you trust Greg Abel with $400 billion of cash, or is the departure of the talent the final red flag for you? If you found this deep dive into the 2026 Berkshire transition helpful, do not forget to check out our next video on the top 5 stocks. JP Morgan is targeted for their new 10B fund. The moves Todd Combs is likely making right now. You can find that video on the screen right here. Thanks for watching, and remember, in a market without an oracle, your best defense is your own due diligence. I'll see you in the next one.